Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 18th, 2026.
Glad to be here for another deep dive.
So, I want you to imagine firing 8,000 of your own employees today.
Oh, wow.
Yeah, right. And not because your company is failing, not because, revenue is collapsing or anything like that, but because you desperately need the cash to buy robots and server racks.
Right, trading people for compute.
Exactly. That is exactly what Meta is doing today, and it's sending a massive shockwave through the tape. So if you're looking at your portfolio right now and wondering why your supposedly safe, high-growth tech stocks are suddenly bleeding.
Yeah, they're taking a hit.
While old-school, capital-heavy airlines are actually catching a bid, you are definitely not alone.
No, it is an incredibly disorienting market right now if you're just looking at the surface numbers.
Definitely.
We are sitting at a very specific, very volatile intersection today. You have an enormous geopolitical shock hitting the physical supply chain.
Which we'll get into.
Right. Plus a major changing of the guard at the Federal Reserve. And then on top of all that, a tech sector that is literally cannibalizing itself to fund the next generation of artificial intelligence. It's really a structural rewiring of the market.
Yeah, so let's pull up the tape and look at that rewiring in real time. Because if we glance across the major U.S. indexes, the overarching theme is red, but it's sort of a fractured picture, right? The indexes are edging lower, but the volume is strangely anemic. It doesn't look like widespread panic to me.
No, not at all. It looks like people holding their breath.
Exactly.
The market is essentially playing a high-stakes waiting game. Institutional capital is being shuffled around. It's being parked in defensive structures.
Right, because we're walking into one of the most consequential earnings weeks of the entire year.
Nobody wants to be caught offside. But within that quiet shuffling, the underlying currents are incredibly violent.
They really are. And I think the most glaring current today is this massive divergence between technology and fixed income. The tech sector is actively sliding, and that's dragging the Nasdaq down into the mud. But if you look over at the bond market, Treasury yields are they're aggressively climbing.
They are.
If you think of the market as an engine, it feels like the tech cylinders are misfiring today, specifically because that bond yield pressure gauge on the dashboard is suddenly flashing bright red.
That's a great way to put it. And that relationship, it's pure mathematical gravity.
Right.
High-growth technology stocks are valued based on cash flows. They're expected to generate years or even decades in the future.
Way down the line.
Exactly. So when the yield on a virtually risk-free U.S. Treasury bond spikes, the present value of those distant tech profits just plummets.
Because investors demand a higher premium.
Right. They demand a higher premium to take on the risk of holding a tech stack when they can get a guaranteed, elevated return straight from the government.
Makes total sense. So let's dig into the why for our listeners. What is forcing that bond pressure gauge up so violently right now?
It's a combination of things.
Right. And that brings us to our first major piece of the puzzle for this deep dive. The Federal Reserve, the shifting leadership, and some highly aggressive positioning in the bond market. Because this Friday, we've got Kevin Warsh set to be sworn in as the new Federal Reserve Chair.
Yeah. And the bond market is basically throwing a preemptive welcome party, I guess you could call it.
A pretty hostile one.
Seriously.
Yeah.
By pricing in a deeply restrictive monetary environment, we just saw the 10-year Treasury hit a staggering 4.631% this morning.
4.631. Wow.
Yeah. And if you look through the institutional notes today, strategists are openly floating the threat of a surprise interest rate hike in July.
In July?
Yes. And the justification you keep seeing over and over is that the Fed has to, quote, appease the bond vigilantes.
Okay, let's unpack that right there.
Yeah.
I really want to push back on that phrase, bond vigilantes.
It's a dramatic term.
It is. It makes it sound like there's some smoky backroom of, unelected traders who sit around deciding to punish the real economy and force the Federal Reserve's hand.
Right.
But why do these traders actually have the power to essentially mandate an interest rate hike in July?
Well, it's less of a conscious conspiracy and more of a mechanical defense mechanism.
Okay.
Bond vigilantes is actually an old trading floor term from the 1980s. It refers to bond investors who see inflation coming down the pike and realize the fixed return on their current bonds is about to be eaten alive by rising prices.
So they have to react.
Right. So what do? They sell. They dump their existing Treasury bonds to protect their capital.
And because bond prices and bond yields move on an inverted seesaw, Dumping the bonds drops the price, which mathematically forces the yield up.
Precisely. And here's where it actually bleeds into your life, right?
Mm-hmm.
That 10-year Treasury yield is the bedrock for the entire global financial system.
Because it sets the tone for everything else.
Exactly. It dictates the interest rate on everything from your 30-year mortgage to a major corporation's line of credit.
Wow. Okay.
So when these bond investors aggressively sell off and push that yield to 4.631%, they're actively tightening financial conditions in the real economy all by themselves.
Without the Fed doing a thing.
Right. The Fed watches this happen and realizes the market is screaming about inflation. And if the Fed doesn't validate that fear with official policy—
Like a rate hike in July.
Exactly. If they don't, they look completely out of touch. They risk losing their credibility, which would trigger an even more catastrophic bond sell-off.
So the market isn't trying to punish the Fed, it's just reacting to a physical reality. And the Fed is just, they're being dragged along for the ride.
Yeah, they have no choice.
Which begs the question, what physical reality is terrifying the bond market so much right now? Because our sources point definitively to the global supply chain.
Specifically oil.
Right, the massive disruption in the oil market following the geopolitical shockwaves in the Middle East.
Yeah, you really cannot separate the bond market's fear of inflation from the our own war oil squeeze. It's impossible. Oil is the literal lifeblood of the physical economy.
It's just everything.
It is the base layer of production. When crude oil spikes, the cost to extract, to manufacture, and to transport every single tangible good on Earth goes up.
And the timeline we are looking at in the data for this deep dive it's deeply alarming.
It's not great.
We aren't just talking about a temporary price spike, are we? The projections show actual physical oil shortages hitting Europe within a matter of weeks. And more structurally, global inventories are forecasted to remain severely depleted all the way out to 2027. I mean, we are staring down the barrel of years of supply chain friction.
Which guarantees years of inflationary friction.
Yeah.
The bond market is looking at that 2027 timeline, and they're just doing the math.
Right.
They know that you cannot simply print your way out of a physical energy deficit.
Yeah.
You just have to endure the higher prices until new supply eventually comes online.
But this is where the data gets incredibly weird to me, and frankly, a little contradictory.
How so?
Well, we have soaring bond yields, which means mortgage rates are climbing, right?
Mm-hmm.
We have a global energy panic and supply chain bottlenecks through 2027. And yet, the domestic data that just dropped shows U.S. homebuilder sentiment actually improved.
Yeah, the housing numbers.
We saw a massive late spring surge in housing demand. How does that make any logical sense in this macroeconomic environment?
It's wild, right? It's one of the most fascinating paradoxes in the market right now. It highlights a very bizarre insulation of the domestic U.S. housing market from all these global macroeconomic shocks.
Yeah, because why are home builders feeling optimistic when the rest of the world is bracing for shortages?
They feel like two completely separate realities.
Totally.
And that's because structurally it is. The domestic housing market isn't functioning on normal supply and demand dynamics right now. It is paralyzed by a profound lack of existing inventory.
Oh, because of the rates.
Exactly. Millions of homeowners are sitting on 3% or 4% mortgages that they locked in during 2020 and 2021.
Right, they're not going to let those go.
They simply refuse to sell and take on a new mortgage at today's 7% rates. It's a lock-in effect.
So if you are a buyer right now, you are essentially starved out of the secondary market. Your only option is to go buy a brand new house.
Exactly. That late spring surge in demand wasn't a sign of economic euphoria at all. It was buyer capitulation.
They just gave up.
Right. People who delayed buying a home for 2 years finally gave up, accepted the higher borrowing costs, and went straight to the home builders because existing homes just aren't for sale.
Wow.
So the builders are somewhat insulated from the global oil shock because their specific, immediate demand curve is completely warped by this domestic gridlock.
That is fascinating. And that physical bottleneck in housing, the reality that you cannot just hit copy-paste on a suburban subdivision to meet sudden demand.
It takes time.
It requires permits, lumber, time. That is exactly the same constraint that is suddenly suffocating the digital world today. Which brings us to the tech tape, the AI capital expenditure cycle, and the highly anticipated Nvidia earnings report.
Oh yeah, this is the focal point of the entire market right now.
Absolutely.
Nvidia's earnings release isn't just a referendum on one company's balance sheet anymore. It is a stress test for the entire global artificial intelligence build-out.
And the stakes are, they are quantified. The options market is currently pricing in an implied move of 7% for Nvidia's stock on this earnings report.
7%.
Now, let's break down what that actually means for the listener. Implied volatility isn't just a random guess by talking heads on TV, right? It's a mathematical calculation.
Right. Implied volatility is derived directly from how much traders are willing to pay for options, contract puts, and calls that expire right after the earnings release.
Okay.
When you see a 7% implied move on a company the size of Nvidia, which is a multi-trillion-dollar behemoth, it means institutional money is violently hedging their bets. They are mathematically preparing for the stock to either rip higher or crater by hundreds of billions of dollars in market cap in a single trading session.
In one day.
Yep.
And the pressure is dialed to an absolute 11 because Nvidia's CEO already raised their forward guidance significantly back in March.
They set the bar astronomically high.
They really did. So the market isn't just going to ask, are you profitable? The market is asking, is the global hyperscaler build-out of AI infrastructure still accelerating at breakneck speed?
Because if Nvidia shows even the slightest hint of deceleration, the ripple effects will crush the entire technology sector. Nvidia is the fulcrum.
Which brings us right back to my opening point about Meta. We are seeing companies undergo violent internal restructurings just to survive this transition.
Yeah, the human cost.
Right. Our sources for this deep dive highlight two contrasting stories today. First, Meta is initiating layoffs this week. They're cutting 8,000 workers to prepare for what they're calling the AI era.
And what you are seeing with Meta is a fundamental shift in corporate accounting and resource allocation. They are ruthlessly trading human capital for compute capital.
Just swapping them out.
Literally. They are slashing operating expenses, salaries, healthcare, office space, for those 8,000 employees specifically to free up billions of dollars in capital expenditures, or CapEx.
Why? Just to buy more servers?
Because you have to buy NVIDIA's chips to train the models that will keep your platform relevant.
And Wall Street generally rewards that, right? Because an employee is an ongoing expense, but a rack of highly advanced servers is a capital asset.
Exactly.
It can theoretically generate revenue 24/7 without needing a coffee break.
It is a brutal but highly efficient reallocation of capital.
But then you have the flip side of this AI transition, which is Seagate.
Right, the hardware reality.
They're a massive hardware and data storage company, and they are leading a deep memory sector sell-off today because their CEO bluntly admitted on a call that it will, quote, take too long to build new fabrication plants.
And this is where the digital dream collides with physical reality.
It really reminds me of the electrification of the United States in the 1920s.
Oh, that's a good comparison.
Think about it. Nvidia is the company building the massive high-tech electrical turbines. They are the darlings of the era. But Seagate is the company tasked with physically digging the thousands of miles of muddy trenches to lay the copper wire to connect everyone to the grid.
And that takes actual dirt and sweat.
Exactly. Seagate's stock is selling off because investors are suddenly remembering that you cannot magically wish a semiconductor fab or a data storage facility into existence.
Right. It takes years of pouring concrete, bending metal, and navigating environmental regulations.
All physical.
The AI infrastructure build-out is entirely constrained by the speed of the physical world. No matter how many software engineers Meta fires or how much CapEx they dedicate to the problem, they are bottlenecked by raw materials, energy grids, and factory floors.
So, in the middle of all this chaos, between looming interest rate hikes, oil shortages, housing paradoxes, and the clash of digital and physical infrastructure,
That's a lot.
how are the true titans of capital positioning themselves? Let's look at Warren Buffett and Berkshire Hathaway.
Always a good idea.
They just revealed a completely revamped portfolio through their latest filings, and I have to say, the moves are deeply counterintuitive.
Well, Berkshire's portfolio adjustments are always a masterclass in reading the macroeconomic tea leaves. What exactly did they disclose?
The data highlights 4 major shifts. First, they took a massive $2.6 billion stake in Delta Airlines, ticker DAL.
Okay.
Second, they increased their existing shares in Alphabet, Google's parent company, by a staggering 224%.
Oh.
Third, they completely exited a 5 million-plus share position in the healthcare giant United Health, ticker UNH. And finally, they initiated a new 3 million share stake in Macy's, ticker M.
Interesting. What we're looking at here is a classic, highly aggressive barbell strategy.
What does that mean?
They were loading up on completely opposite ends of the risk spectrum. On one side of the barbell, They are buying into deep value, physical world recovery plays. Delta Airlines and Macy's.
Let's focus on Macy's for a second. Why on earth is Warren Buffett buying a legacy department store in 2026? It can't just be because he thinks they're going to sell a lot of winter coats this year.
No, it rarely is with Berkshire. The Macy's play is almost certainly a real estate arbitrage.
Real estate.
Yeah. When you look at legacy retailers like Macy's, the actual retail business might be struggling, but they own the physical dirt under hundreds of massive stores in prime urban and suburban locations.
Oh, I see.
Often, the liquidation value of that real estate alone is worth more than the entire market capitalization of a company.
That's crazy.
Buffett isn't betting on retail. He's buying high-value commercial real estate at a steep discount, disguised as a department store stock.
That makes perfect sense. And the Delta Airlines move. Allocating $2.6 billion to an airline right as the global oil supply is squeezed by a war in the Middle East.
It's gutsy.
It's an incredibly bold, contrarian bet.
It really implies a belief in the sheer resilience of the consumer. Berkshire is betting that despite the inflationary friction of oil, people will just continue to prioritize travel and experiences.
Okay, but let's look at the other end of the barbell. Increasing their Alphabet stake by 224%.
The tech side.
Right. Berkshire is historically terrified of complex tech companies. And frankly, Alphabet is facing some of the most severe antitrust and regulatory headwinds we've seen in a decade.
Definitely.
Their search monopoly is constantly under threat. Why quadruple down on them now?
Because Berkshire recognizes that the AI transition is a structural reality, not a cyclical fad.
They see the moat.
Exactly. Yes, Alphabet faces regulatory noise, but they possess an almost unassailable moat when it comes to the infrastructure required for AI. We're talking massive proprietary datasets, endless compute power, and just unmatched engineering talent.
So they're looking past the courts.
Buffett is looking past the regulatory fines and seeing a utility-like monopoly on the future of digital infrastructure.
And their exit from United Health, dumping over 5 million shares.
That's pure de-risking. Healthcare right now is a minefield of margin compression and unpredictable government regulation. Berkshire clearly surveyed the landscape and decided that the capital appreciation upside was far superior in pure-play AI tech and deep value real estate than it was in managed healthcare. They took their chips off that table to fund the barbell.
And those massive gravitational moves by Berkshire, combined with some enormous corporate mergers, are the exact catalysts driving today's individual stock swings.
Let's get into the tape.
Let's do a rapid-fire breakdown of the market movers, starting with the gainers.
Let's hear the winners.
Dominion Energy, ticker D. It soared 9.78% today to $67.77. The driver here is a massive mega merger announcement.
Big move.
Then we have Macy's, ticker M, up 3.5% pre-market purely on the news of Berkshire's 3 million share stake, and Delta Airlines, DAL, up 2% after Berkshire revealed that $2.6 billion position.
Yeah, that is the Buffett bump in action.
Right.
When the Oracle of Omaha signals confidence by allocating capital, a massive wave of retail and algorithmic institutional money just blindly follows.
But let's look at the losers today, because this is where the mechanics get really interesting.
Okay.
The flip side of that Dominion Energy merger is NextEra Energy, ticker NEE. NextEra dropped between 1.7% and 3.5% today after announcing they're the ones acquiring Dominion.
Right.
In a $66.8 billion all-stock merger. Now, for the listener wondering why a company's stock drops when they announce they're buying a competitor, it's not just basic dilution, is it? It's about how the hedge funds play it.
Exactly. It's a mechanism called merger arbitrage.
How does that work?
Because it is an all-stock deal, NextEra will eventually have to issue a specific ratio of its own shares to give to the Dominion shareholder.
Okay, that makes sense.
So the moment that deal is announced, hedge funds immediately step in to capture the spread between the two stock prices.
They want that easy money.
Right. The standard playbook is to buy the target company, in this case Dominion, which drives its price up, and simultaneously short sell the acquiring company NextEra, which structurally drives its price down.
Wow.
This arbitrage locks in a nearly risk-free profit for the funds, assuming the deal actually closes. But it forces the acquirer into the red on day one. Add in the sheer headache of integrating a $66 billion giant, and investors always shoot first and ask questions later.
So it's a perfect storm of mechanical selling and integration fear.
Pretty much.
Moving down the losers list, United Health, UNH, down 2.15%.
The reverse Buffett bump.
Exactly. Berkshire abandoned ship, so the momentum traders rushed for the exits too.
Yeah.
And finally, Nvidia, ticker NVDA, down 1.73% today, which is wild considering they are the center of the universe this week.
But it perfectly ties back to the options market data we discussed earlier.
You think so?
Oh, yeah. A 1.73% drop isn't a fundamental indictment of Nvidia's business model. It is active portfolio de-risking.
Taking chips off the table.
Right. When you are a fund manager and you see that 7% applied volatility, you realize the stock could violently swing in either direction.
It's a gamble.
Exactly. A lot of managers look at that and say, I am not going to gamble my entire quarterly performance bonus on a coin flip. Let me sell a fraction of my position right now, lock in some games, and just reduce my exposure to the blast radius.
That makes total sense. So we have covered an immense amount of ground today for this deep dive.
We really have.
We've explored the mechanical sell-offs of the bond vigilantes, the structural gridlock of the housing market, the physical concrete bottlenecks of the AI revolution, and Warren Buffett rearranging the macroeconomic chessboard.
It's a lot to process.
It is.
Yeah.
So pull this all together for us. If a listener takes away one grand synthesis from today's data stack, what is it?
If you distill all of these sources down, the architecture of the market today basically rests on 5 deeply interconnected pillars.
Okay, let's hear them.
Pillar 1 is earnings. Nvidia is the absolute linchpin for the global AI capital expenditure narrative. If they stumble, the justification for the entire tech sector's valuation stumbles.
Makes sense. Pillar 2.
Pillar 2 is the Fed and rates. Kevin Warsh's arrival and the very real mechanical threat of a July rate hike are actively terrorizing the bond market, keeping yields elevated and pressuring growth stocks.
Right. And pillar 3 would be the global economy and commodities, right?
Exactly. The Iran oil squeeze guarantees that inflationary friction is locked into the system. We are looking at depleted physical inventories through 2027, which means the Fed has very little room to maneuver.
Wow. Okay, pillar 4.
Pillar 4 is tech and AI. We are witnessing a ruthless physical to digital labor transition. Companies like Meta are literally trading human jobs to pay for AI infrastructure, while the smartest money in their own Berkshire aggressively buys into Alphabet's moat to capture the upside.
Fascinating. And the final pillar.
Volatility. The 7% implied move in Nvidia's options is a flashing warning sign on the dashboard. Investors are priced for absolute turbulence because they understand the historical stakes of this transition.
You know, digesting all of this leaves me with a really profound puzzle to chew on.
What's that?
We are supposedly entering this pristine, frictionless AI era where digital efficiency rules absolutely everything. We are told the future is algorithms and limitless compute.
Right, the digital utopia?
Exactly. Yet, if you look closely at the real drivers of the market today, the global economy is currently being held hostage by physical, tangible barrels of oil in the Middle East. And the grand AI revolution itself is being actively delayed by the need to pour physical concrete at Seagate's manufacturing facilities. It really makes you wonder, is the future really entirely digital, or are we just finally realizing how fragile our physical world really is?
That's the million-dollar question.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.